Howdy, my friend, welcome to Squirrel On Charts, your resource for advanced trading education. If you have been a trader for some time, you have probably heard a lot about the risk-reward ratio, but no one really tells you how to find the best ratio for your trading strategy. So let me help you out. Let's start with a quick recap. The risk-reward ratio is the ratio between how much you risk and how much you can potentially earn with your trade. If you risk 100 to earn 100, you have a risk-reward ratio of 1. If you risk 100 to earn 200, you have a ratio of 2. And if you risk 100 to earn 50, you have a ratio of 0.5. A fairly simple concept. But here is the key point. The risk-reward ratio in itself is completely meaningless. You must always consider the probability of reaching your target as well. Having a high risk-reward ratio is simple, but having a high risk-reward ratio and a good probability of reaching your target is difficult to get. No one is stopping you from choosing a risk-reward ratio of 10, but what's the probability of reaching that target? In general, there are two problems I commonly see. A trader either chooses a too high or too low risk-reward ratio. If your risk-reward ratio is too high, you will experience many long losing streaks. This is difficult for a trader to deal with, and in order to be profitable long-term, the trader needs a big win every now and then. But if the trader misses that one good trade, that would have made him a lot of money, then he will be even more frustrated. And even if he catches that one trade he so desperately needs, what are the chances of managing that trade perfectly in order to get a big profit? But choosing a too low risk-reward ratio isn't good either. If your risk-reward ratio is small, chances are that you will have a lot of small wins in a row. However, the trader is always scared of that one trade where he will get stopped out. And if he gets stopped out, the profits of many successful trades will be gone. So, let's look at some realistic risk-reward ratios. Let's start off with the standard ratio of 1. In order to be profitable with a ratio of 1, you need to win a bit more than 50% of your trades. A risk-reward ratio of 1 is relatively comfortable to trade. You won't have long losing streaks, and you don't have to worry about a big loss that eliminates all of your previous earnings. Your only job is to find a strategy that has at least a 50% probability of hitting your target. On the two pictures below, you can see examples for a risk-reward ratio of 1. On the left-hand picture, you trade in the direction of the trend, but maybe you aren't sure how far the trend will continue to go, so you only choose a risk-reward ratio of 1. On the right-hand picture, the market went up quickly, and then down quickly. While there is no clear trend, you expect the market to retest the previous high. Because of the recent strong bullish candles, you expect that the probability of retesting the high is at least 50%, and so you choose a risk-reward ratio of 1. Next, let's talk about a slightly higher risk-reward ratio. A ratio of 2 to 3 is still realistic and commonly chosen by many traders. A ratio like this makes sense for low-probability strategies. A common example would be betting on a trend reversal. The right-hand picture shows this exact situation. To offset the low probability of the trend actually reversing and hitting your take profit, you choose a higher risk-reward ratio. On the left-hand picture is a similar situation. The trend lost strength and turned into a broader trend channel. There have been a few strong bearish candles, and so you bet on the trend reversing. Again, because of the lower probability, you choose a higher risk-reward ratio. Alright, let's now talk about a risk-reward ratio of less than 1. If you want to choose such a low ratio, you have to be confident that your strategy offers a fairly high probability of hitting the target. On the left-hand side, you are trading in the trend's direction, but instead of trading the complete trend, you just bet on the market retesting that last high. Because the trend is still strong, there is a good probability of the market actually testing that high. Therefore, you might be fine choosing a lower risk-reward ratio. On the right-hand picture, the market went more sideways. But you have noticed that the market tried a few times to make a new low without success, so you bet on the market moving at least slightly up again. The chances of the market moving slightly up before going down and breaking through the support zone are good. Therefore, you could perhaps trade with a lower risk-reward ratio. Okay, let's end with a conclusion. First, the risk-reward ratio is meaningless when you do not consider the probability of hitting your target as well. Next, your risk-reward ratio should stay in a realistic range that you can manage to trade in the long run. Both too low or too high risk-reward ratios can result in many problems that make it difficult for you to earn money. Last, you should always think about the probability of your strategy hitting your target before thinking about the risk-reward ratio. If you trade a low probability strategy, the only way to make money is by offsetting the lower probability with a higher risk reward ratio. However, if you take high probability trades, you might be fine with a lower risk reward ratio. Alright, that's it for today. If you are interested in more advanced trading education, feel free to subscribe. Good luck on your journey, bye.